1850, Montgomery, Alabama. Three German immigrant brothers open a small cotton trading store. It becomes the fourth largest investment bank in the United States. It survives the American Civil War, both World Wars, and the Great Depression itself. It survives every financial crisis of the 20th century without ever failing. In 2006, it decides to become the most aggressive lender in the American subprime mortgage market. In 2007, it holds $60 billion in toxic real estate assets. On September 15, 2008, it files the largest bankruptcy in American corporate history. Its name is Lehman Brothers. 158 years of history destroyed in only 3 days. This is the story of the bank that survived the Civil War, 2 world wars, and the Great Depression, but was destroyed by its own certainty of being too big to fail. Henry Lehman was born on September 23, 1821, in Rimpar, a small Bavarian town in what is today modern Germany. He was the son of Abraham Lehman, a cattle merchant of modest origins, struggling in the difficult economic conditions of 19th century Bavaria. In 1844, at the age of 23, Henry Lehman decided to emigrate alone to the United States, seeking better economic opportunities elsewhere. He settled initially in Montgomery, Alabama, working first as a traveling peddler across rural southern communities and eventually opening a general store. In 1847, his brother Emanuel Lehman joined him from Bavaria. Then Meyer Lehman arrived from Germany in 1850, completing the founding trio of brothers. That same year of 1850, the three brothers officially founded Lehman Brothers as a small commodities trading firm focused on cotton commerce initially. They accepted raw cotton as payment for goods, understanding cotton was the true currency of the antebellum American South during that historical period. In 1858, the brothers opened a strategic office in New York City to trade cotton directly on the New York Cotton Exchange in Manhattan. The American Civil War from 1861 to 1865 devastated the cotton economy, but the brothers successfully repositioned themselves for post-war economic reconstruction. In 1870, Lehman Brothers helped found the New York Cotton Exchange, becoming a central institution in the post-war national commodity trading system. Emanuel Lehman moved permanently to New York while Meyer Lehman remained in Alabama, managing the crucial southern cotton operations for decades. In 1887, Lehman Brothers acquired membership on the New York Stock Exchange, transitioning gradually from pure commodity trading toward general investment banking activities. By the early 1900s, the second generation of Lehman Brothers, led by Philip Lehman, expanded aggressively into securities underwriting and industrial financing throughout America. Lehman Brothers helped finance American retail giants including Sears Roebuck, Woolworth, Macy's, and eventually many major aviation and technology companies of the century. The firm survived the devastating financial panic of 1907 unscathed, thanks to conservative management principles inherited directly from the founding brothers. In 1929, when the stock market crashed catastrophically and the Great Depression began, Lehman Brothers survived without losing a single dollar of client capital. The firm survived World War I and World War II, expanding steadily its investment banking business across multiple decades of dramatic historical change. By 1969, Lehman Brothers had over 100 years of continuous successful operations without ever experiencing a single major institutional financial crisis. In 1969, Robert Lehman, the last direct family descendant leading the firm as senior partner, died in New York at 77 years old. His death marked the end of 119 years of direct family leadership at Lehman Brothers as a founding dynastic institution. The firm entered a difficult period of internal succession struggles among non-family partners fighting bitterly for institutional control during the 1970s decade. In 1984, after years of internal financial and management crisis, Lehman Brothers was forcibly sold to American Express Corporation. The prestigious old firm was integrated within American Express as part of Shearson Lehman Investment Banking Division, alongside other acquired firms. In 1994, American Express decided strategically to spin off Shearson Lehman Brothers as a separate, independent, publicly traded corporation. Lehman Brothers emerged as an independent, publicly traded firm on the New York Stock Exchange, under the leadership of Chairman Richard Fuld. Richard Fuld became Chief Executive Officer and immediately transformed Lehman Brothers into an extremely aggressive, risk-taking investment banking institution. Fuld had joined Lehman in 1969 as a young intern and had risen through the ranks over 25 years of continuous work. He was completely obsessed with growth, market position, and aggressively surpassing established competitors like Goldman Sachs and Morgan Stanley in every possible metric. Under Fuld leadership, between 1994 and 2007, Lehman Brothers' stock price multiplied by 20 times its original independent public value. The firm grew from a mid-tier prestigious investment bank into the fourth largest investment bank in the entire United States by market capitalization. But this extraordinary growth came from taking increasingly aggressive risks, especially in real estate and mortgage-backed securities trading operations. Between 2003 and 2006, the American housing market was booming spectacularly, and Lehman Brothers positioned itself as one of the primary market lenders and underwriters. Lehman acquired multiple mortgage origination companies, including BNC Mortgage and Aurora Loan Services, to fully integrate the value chain vertically. This vertical integration meant Lehman could originate mortgages, package them into securities, and then sell them or hold them speculatively themselves. By 2006, Lehman was systematically originating tens of billions of dollars in subprime residential mortgages every single calendar quarter of the year. Many of these mortgages were extended to borrowers who could not realistically afford to repay them under any reasonable financial scenario. But Lehman was profiting enormously from origination fees and packaging fees, regardless of whether the mortgages themselves would ever be repaid. By early 2007, the American housing market began showing serious visible signs of structural weakness, and Lehman Brothers held $60 billion in real estate exposure. Delinquency rates on subprime mortgages were rising fast, and the specialized subprime lenders were beginning to fail rapidly throughout early 2007. In April 2007, New Century Financial, one of the largest specialized subprime mortgage lenders in America, filed for immediate bankruptcy protection formally. In June 2007, two major Bear Stearns hedge funds specialized in subprime mortgage assets collapsed catastrophically due to escalating losses. This was the crucial first serious warning signal that the entire structure of mortgage-backed securities holdings was becoming systematically dangerous. But Lehman Brothers, under Fuld leadership, decided to double down on its subprime real estate exposure instead of prudently reducing exposure. Fuld genuinely believed that the American housing market decline would be temporary short-term and that Lehman would successfully profit from acquiring distressed assets. He personally was convinced that Lehman Brothers had become truly too big and too systemically important to fail as an institution. This complete institutional certainty was based on a specific recent precedent in modern American financial history. In March 2008, Bear Stearns collapsed catastrophically after a devastating classic bank run and was hurriedly rescued by J.P. Morgan Chase with critical Federal Reserve support. The Federal Reserve had directly provided approximately $30 billion in critical taxpayer guarantees to facilitate the emergency rescue transaction. This urgent rescue established a very clear implicit precedent in the entire financial industry that important banks would not be allowed to fail. Fuld was completely convinced Lehman would receive similar federal government support if the situation ever became truly desperate. But throughout 2008, Lehman continued reporting quarterly profits publicly, while internally the massive real estate portfolio was rapidly deteriorating. In the first quarter of 2008, Lehman reported $500 million in publicly reported profits, despite worsening internal conditions. In the second quarter, Lehman finally reported its first significant loss of $2.8 billion, but Fuld dismissed it as fundamentally temporary. Throughout summer 2008, Lehman used an aggressive accounting technique called Repo 105 to temporarily hide approximately $50 billion in balance sheet debt. Repo 105 was technically classified as an asset sale for accounting purposes, but functionally represented a short-term loan requiring rapid repurchase. This questionable technique allowed Lehman to make its balance sheet appear structurally healthier at quarterly reporting dates than it truly was. By late summer 2008, investors began questioning Lehman Brothers valuations very seriously, and short sellers were actively attacking the stock. Lehman stock fell from $65 in January 2008 to less than $15 per share by early September that same year. The critical weekend of September 13th and 14th, 2008 changed American financial history forever in ways that continue reverberating. The chief executives of every major Wall Street bank were urgently summoned to the Federal Reserve Bank of New York headquarters for emergency meetings. Treasury Secretary Henry Paulson led the crucial meetings personally, alongside Federal Reserve Chairman Ben Bernanke and Timothy Geithner from the New York Fed. The specific objective was to find any solution that would prevent Lehman Brothers from filing bankruptcy and triggering wider systemic financial catastrophe. Fuld arrived at the meetings absolutely convinced that the government would ultimately arrange another emergency rescue, exactly as had been done with Bear Stearns previously. Two potential buyers had emerged during the previous week to consider acquiring Lehman Brothers on emergency conditions. Bank of America was the first potential acquirer, but ultimately decided to acquire Merrill Lynch instead on that same critical weekend. Barclays from Britain was the second potential buyer and was seriously interested in acquiring Lehman under specific conditional terms, but Barclays required the American Treasury to guarantee Lehman assets before completing the acquisition transaction legally. Paulson categorically refused to provide any such guarantee, marking a decisive strategic policy change from the previous Bear Stearns rescue. British regulatory authorities also refused to approve the emergency acquisition without formal American governmental guarantees firmly in place. This regulatory impasse essentially closed the last possible practical option for saving Lehman Brothers from the immediate bankruptcy filing. In the early morning hours of Monday, September 15th, 2008, Lehman Brothers officially filed for bankruptcy protection legally. It was the largest bankruptcy in American corporate history, involving over $639 billion in reported total assets. 25,000 Lehman employees lost their jobs immediately worldwide as the historic institution was liquidated across multiple countries. The company stock became completely worthless overnight, wiping out billions of dollars in institutional and individual investor value. The global financial system entered immediate cardiac arrest, with credit markets freezing completely worldwide within just hours of the historic filing. The Dow Jones Industrial Index dropped over 500 points that day, marking the beginning of the worst American financial crisis in decades. Fuld watched the collapse from his corner office, still maintaining that the government should have provided the rescue support that never came. The consequences of the Lehman Brothers' historic collapse were absolutely devastating for the entire global financial system within days. Credit markets froze completely worldwide because no financial institution knew which other institutions were also fatally exposed to toxic Lehman debt. Money market funds began losing money publicly for the first time in modern American financial history, creating widespread investor panic. The American government was suddenly forced to enact the massive $700 billion TARP program to save the entire remaining banking system. AIG the massive insurance company, required an even larger urgent rescue of $180 billion. Just days after the Lehman collapse, Merrill Lynch was hastily absorbed by Bank of America to prevent another similar catastrophic bankruptcy from occurring in the same period. Goldman Sachs and Morgan Stanley converted urgently into bank holding companies to access emergency Federal Reserve support facilities and funding lines. The Great Recession officially began that same September 2008 and lasted formally until June 2009, becoming the worst American recession since the 1930s. Approximately 9 million Americans lost their homes to foreclosure during the extended crisis period between 2007 and 2013 completely. The global economy lost approximately $15 trillion in accumulated wealth during the historic crisis and its long extended aftermath. Richard Fuld personally lost approximately $500 million in personal Lehman Brothers stock value that had accumulated over years. But he had reportedly extracted approximately $500 million in personal compensation during his 14 years leading Lehman Brothers publicly. He never faced any formal criminal charges, despite the Repo 105 accounting concealment and the systematic hidden institutional collapse. In 2009, he founded a small private consulting firm and eventually returned to work in various restructuring and advisory activities. He maintained publicly, for years afterward, that the American government made a huge mistake by refusing to rescue Lehman Brothers. The first lesson is about how the institutional certainty of being too big to fail can transform into deadly institutional recklessness. The second lesson is about how catastrophic decisions can be made based on misinterpretations of very recent historical precedents. The third lesson is the hardest to accept. Every institution that ever believed it was too big to fail eventually discovered it was wrong. This is the story of the bank that survived 158 years of American history, but was destroyed by 3 days of certainty. If you choose to witness their stories, subscribe to Rise and Ruin. Next, we follow another empire from glory to dust.